Hello friends, welcome to my YouTube channel. Today I am taking one interview question from the capital market business analyst domain, and apart from the interview perspective I will also explain some theoretical knowledge as well. Sometime interviewer can ask you this type of question just to understand, do you have really such type of day in day out experience in this domain, or you are just mug up from somewhere and you are telling me here. Okay, today I am taking topic of bond market. Okay, when I teach my students regarding how to preparation for the business analyst interview process, all those things, I have understood that sometime when interviewer asks you that explain the bond yield, bond market, treasury, etc., most of the time you need to focus on such things in such a way so that your communication will be understandable from the interviewer perspective. It's not an exam, like it's not an university exam, you are just writing something. Your process, how you are going to explain it to the interviewer in such a way so that interviewer can understand it, it will be very positive point if you can represent yourself in such a way. So question is, first let me come to the question part. Question is, interviewer can ask you, and it's a very popular question from investment bank perspective, and when you want to join any organization as a business analyst where your work will be assigned on capital market domain. Question is, what do you understand of treasury, what are the types, and explain about the bond yield and inverse bond yield curve. Interviewer can ask you not all the questions once at a time. Interview can ask all these questions one by one, or any particular one question, or sometime interviewer can ask you all the question part by part basis. Okay, so I am taking all these question at a one chunk and I am explaining you how you should represent yourself, how you should answer this type of questions in the interview process. First let me explain about the treasury. Treasury basically the three types: the treasury T-bills, the treasury note, and treasury bond. Treasury T-bills basically the short time duration, it can be the 91 days, it can be the 182 days, etc. Treasury note little bit higher, it can be the 2 years, it can be the 5 years, etc. In case of treasury bonds, it's a long duration, like let's say 10 years, 30 years, etc. Okay, now question comes, what are the implementation of this treasury bond? Why I should go with the treasury bond? Sometime let's say you need some money. As a normal people point of view, you should go to bank and you will take loan. Sometimes government also need loan. So in that case, government borrow money from normal people, from the general people. And how they borrow money from the general people? They issue treasury bond. As per the requirement, it can be the short term requirement from the government perspective. They will go ahead with 90 days, 180 days, something like that. It's a long duration, some infrastructure project is going on, some road is building, etc. They will go ahead with the long term bond. Can be the 10 years, 30 years, etc. Okay, now let's say, once again think about the normal people perspective. once you take loan from the bank and when you are going to repay that loan to the bank, you will pay some interest. In the same way, when government borrow money from you, in the, let's say, government issuing one bond for the 950 rupees, and let's say duration is 10 years. At the end of the 10 years, government will pay you 1000 rupees. That means 50 rupees extra. That means initially you have paid 950 rupees. At the end of 10 years, you will get 1000 rupees. That means 50 rupees extra. This 1000 rupees is known as the face value of that particular bond. Okay. Now question comes, what's the bond yield? What you have put? You have put 950 rupees. What are the interest government is paying to you? 50 rupees. That means you are getting 50 rupees interest on behalf of 950 rupees. That means 50 divided by 950 into 100. That means what are the calculation you are getting? You are getting almost 5 point something. That is the bond yield basically. You are getting that particular interest. Now one interesting part. If you go with some premium investment bank interview, I am not taking any name here. If you go with that interview process, sometime they can ask you, give me the explanation of the bond yield. So what's the bond yield? Earlier you are getting 50 rupees and you have put 950 rupees. That means 50 rupees is interest with respect to 950 rupees. Now, if the bond demand is increased, your bond price will also increase, but face value will be same. That means, let's say 950 rupees has been increased to 960 rupees. Face value is same. That means you are getting interest from government 40 rupees. That's why your total face value will be 1000 rupees. You are giving 960 rupees and 40 rupees as the interest, so total is 1000 rupees. So you are getting 40 rupees as the interest on behalf of 960 rupees. So your interest rate will be, bond yield will be 40 divided by 960 into 100. That means you will get 6 point something. Okay. So not 6, you will get 4 point something. 100 divided by 24, you will get 4 point something. Earlier you are getting 5 point something. So once the bond price is increasing, your bond yield is decreasing. So it's the inversely proportional. You have to convey your thinking style. You have to convey your presentation in such a way so that your interviewer can understand these things. It will be a positive impact for your interview process. Now, I am coming to the yield perspective, yield curve perspective, all those things. Again, it's a very good question. Nowadays, many organizations ask this question, and if you go to the premier organization, premium investment bank, all those things, tier 1 investment bank, you can expect such type of question. You can expect more harder question, but at least this type of question they will ask you, the inversion curve, etc., reversion, etc. So in generally, let's say for a normal person perspective, I am explaining you. Suppose someone is taking loan from 2 years. Let's say interest rate is 5%, and someone is taking loan from, let's say, 30 years. Interest rate should be high because I don't know what will happen for that particular long duration. So I should take maximum premium. That means interest rate will be high. So in a normal point of view, let's say 2 years bond yield, let's say 5%, and 10 years bond yield will be 6%. That means more the duration, bond yield will be high. And it's a general perspective. But in case of recession, what will happen? In case of recession, you don't know what is going to happen in the next upcoming few months, upcoming few years. So you will charge, you will take extra interest for the short duration. But long duration, you know that the situation will be compromised, situation will be normal. So long duration, it will be not your headache. But short duration, it will be your headache. You will take extra premium, you will take extra interest for the short duration. That means for the recession time, or when there is an indication of the recession, what is going to happen? Let's say your 2 years interest bond yield will be, for the 2 years, I am talking about the 2 years period, it will be, let's say, 5%. But your 10 years will be, let's say, 5.5%. So gap is narrowed down, and sometimes it can be the less than 5% as well. That means upcoming few months, upcoming few years is a most disturbance situation. I don't know how the world economy is going to work, and it is very normal situation. For the last 100 years, when the US is going to recession, this type of phenomena has been observed. Last time it has observed 2019 August September, in this time. After 6 to 7 months, COVID came, the whole world was under the grip of the pandemic. But last time it has observed the 2019 August September in this time. So now come to the conclusion. What's the yield inversion curve? When your short-term bond rate will be higher than your long-term bond yield rate, then there is a indication of recession. Generally, your yield curve will be steeper. But when this type of situation, recession type of indication is going to arise, it will be inverted. So this is known as the yield curve inversion. On the upcoming few videos, I will again take few more questions from the investment bank point of view, the capital market business analyst interview perspective, and I will share some personal experience for some of my students, those who are working different investment bank, different tier 1 organization as the business analyst in capital market domain. I will share all those things in details. Thanks. Kindly share and subscribe this channel. Thank you.